Good afternoon. My name is Stephen Weiss. I'm an attorney at Levenfeld Pearlstein in the corporate group. Really pleased to be moderating the panel today. We've got two terrific panelists who are truly serial acquirers collectively. Don and Joe have done 50 plus deals, and I think they're going to bring a lot to the Mbbi membership. To my immediate left is Don Schumacher. Don is the chairman of Schumacher Capital. I think the best way to describe Don is I think you said it over lunch, Don is a value investor. I think you did your first deal when you were 29 years old, and you've been doing deals ever since.
That was 2 years ago.
Right, 2 years ago.
What are you laughing about? I'm sorry.
To Don's left is Joe Incroci. Joe is the vice president and general manager of the Varon Lighting Group, which is a division of Hubble Lighting. Joe's been doing deals for 20 plus years. He's successfully completed 2 roll-ups within the lighting industry. His most recent roll-up was the Varon Group. It started in 2000, was sold at the end of 2008 to Hubble Lighting. Candidly, this was a deal that was right at the end, let me rephrase that, was immediate post-Lehman, and somehow you pulled off an unbelievable deal at that time when there weren't a lot of deals being done. So kudos to you for that deal. Joe is going to be with Hubble for another 3-4 months. Starting this summer, he will be joining the consulting world. One housekeeping item. This is, we've really thought Joe and Don have got a lot to add to the Mbbi membership. We've got a roadmap of where we want to take this panel, but really, if anyone has any questions, don't necessarily wait. We don't have to wait till the end of the presentation. Put up your hand. Shout out a question. We really want to make Joe and Don available to the membership. So with that said, I'll add one other thing. Is I think everyone will see Joe and Don look at deals a little bit differently, and I think that's why this panel is going to be really exciting. Joe has done a number of 20 plus fold-in acquisitions. Don, as we'll talk about, is really more opportunistic. While he's done some fold-in acquisitions, he's really an opportunistic investor and is willing to look over a number of industries, a number of companies. So again, they look at some things the same, but a lot of things they look at differently. So hopefully that makes this a dynamic panel. So just jumping right in, Joe, I'm going to start with you. You've done 20 plus deals in the lighting business. Tell us sort of, how are you finding these deals? Are these proprietary deals? Are you working with bankers? What's sort of your way to target a company?
Well, 90% of my deals have been proprietary deals. That is, I found them myself. I tend not to want to have deals that are being shopped. And as Steve said, I've done fold-in or roll-ups in lighting. So I'm very involved in the lighting industry. I'm well known. I know most of the companies in lighting. I know the targets that I wanted to buy and add to my group. So knowing the target ahead of time is a big advantage in terms of having a good quality deal being done. So most of my deals were deals that were not being shopped, that I approached the target. I approached them on the basis of some other reason than buying his company, a marketing arrangement, a arrangement to share reps or something else, built up a relationship, sometimes a year or 2 or 3, and eventually turned the target into a seller, and then we did a deal.
Don, what about you? Are you looking
People
at...
come to my office and say, this is a great deal and you can make $100 million tomorrow. That never happens, by the way. I can't make $100 million tomorrow, but people do come to my office. Linda Purcell has shown me companies. Some of the other people have shown me companies. I look at lots of things. Kind of the parameters for me as I've gone through it a little longer in life, I try to limit the size to a little bit bigger companies, 20 million in revenue up to 300 million in revenue. Done some things smaller that are add-ons, some things that aren't. But I describe the deal business as like you're a young man or a young woman and you're dating. So you go out and you meet a lot of people. Your mother introduces you to people. Your friends introduce you to people. You go to your church, your synagogue. You join relationships. You network. Go to bars. And then 3 o'clock in the morning one night, when you're completely drunk, you get on an elevator and your future wife gets on, also completely drunk, and you end up making a deal. So an example of that would be, I'm not kidding either. An example of that would be a few years ago, 12 years ago, I was out in California, in La Jolla, and a friend of mine had me over to dinner at their house. And my wife and I were there, and she said to me, her name was Elise, she said, Don, there's a company for sale called the Weekend Exercise Company. I said, yeah. And she goes, do you know that company? I said, I don't. She said, well, the brand of the company is called Marika. I'd previously owned a company called Danskin. And she said, well, you would know the brand Marika. I said, yeah, I know the brand Marika. And she said, well, the company's for sale. The founder, Arthur Levinson's son, runs it. And because of shareholders, diversified shareholders, the father can't sell the business to Michael, and Michael doesn't know what's going to happen to him. She said, would you like to meet him? I said, sure. So he came over, we had a glass of wine. 3 months later, I bought the company. So you never know where the next good deal is coming from.
Don, when you're looking at a company, how important is culture? Is
The culture in the company?
the culture in the company, and talk about, I guess, in terms of your fold-in acquisitions, is culture an important factor?
It is. You want to, I mean, if it's a good company, you probably have a pretty good culture. If it's a company that's having issues, the culture's probably screwed up. So normally, if the company's making money and doing well and growing a little bit, or even flat, you typically don't have culture issues.
Joe, what about culture in Varen?
Varen was started as a perfect model for entrepreneurs and for me to acquire other entrepreneurs. So I looked for an entrepreneurial company and with entrepreneurial culture. And that for me was very successful. As a matter of fact, when I sold the company to Hubble, which is a $3 billion corporation, for the first 3.5 years, my biggest challenge was to have my entrepreneurs settle down and try and deal with a large bureaucracy. And I'm proud to say I only lost one guy in the 3.5 years.
Don, when you're valuing a company, does the benefit of shared synergies, does that go into your valuation at all?
Sure. If we've got a company that already is existing in an industry, we'll probably pay a little more for that company if we see synergistic opportunities. And it isn't just cutting heads. It can be other markets we pick up, purchasing opportunities, a myriad of things.
Joe? Same question.
Well, again, I was selecting a target, a company that I wanted to buy. So I was more a gap filler. I'm looking for, I have a particular platform with the Varen Group was energy efficient lighting. So within that platform, I looked for a company that would fill a gap that I did not have. So shared synergies was important, but more important to me was gap filling.
You mentioned energy efficient lighting. Let's talk a little bit about sort of green deals or energy efficient deals. Does sort of having a green label attached to a target, does that change the valuation, or are those companies valued the same way as any other company?
Right now, green deals, and there's a lot of them being done in lighting because LED technology, which I don't know how many people have heard of, but that's probably one of the most disruptive technologies in lighting since Edison invented the light bulb. And those deals are being done for multiples of EBITDA that are just off the map. My own company went off at 15 times EBITDA. Just recently, we had Cree, which is a large semiconductor company, buy the Rood company in Wisconsin. If you have a branch in Wisconsin, I understand you guys do. Bought the Rood company out of Racine, and the deal went for about 3 times sales. Okay. So yes, right now in my industry, there's a big premium attached to green companies.
So let's talk about you guys. You find a deal, and Joe, in your world, you said it takes you. You're at the dance for a while with a company. You find a deal. At a certain point, you're going to get to a letter of intent. Presumably, that's sort of the first legal step. We had an interesting conversation a few weeks ago, and it's certainly worth sharing with the group. Tell the group sort of your thoughts, long-form LOI, short-form LOI, from a buyer's perspective. What are you going out with?
You addressing that to me?
I'm addressing it to you.
I prefer a very, very short LOI. I do not like to negotiate the deal in the LOI. I think it's a waste of time, and it's too inflexible. So my preference is simply a very short LOI that lays out the skeleton of the deal, and then start the process of due diligence. And when I get to the purchase agreement, it'll be defined there.
Don?
With all fairness to the lawyers in the room, including you, don't let your lawyer do an LOI, because you'll never get to a contract. So from my point of view, I also want a short LOI that talks about the terms of the deal, gives me a period of time to do my due diligence, and that's what works for me.
So you think a long-form LOI that sort of spells out everything is that scaring away sellers that you're talking to?
Well, I've got stories, I've been doing this since I was 29, so I've got a million stories on this stuff, right?
Yeah.
I like you. I need your card. So the deal business ages you quickly, by the way. So I think that whenever I've had we were trying to buy a company from a public company, and the company was a small division. It was announced that it was being sold, small division of the public company. It was a $100 million company, about a $50 million deal. And I sent the LOI out. The guy who got the LOI is a divisional guy at the company, gave it to the attorney of this large public company. So he sends me back an LOI that is, all marked up. I shot it over to and he insisted on talking to my lawyer. 4 weeks later, the deal blew up because we couldn't get through the LOI. If we'd have been able to just have a short-form LOI that named the deal, we'd have gone into a contract. We'd have closed the deal. So that's the problem, from my point of view.
Certainly in a short-form LOI, you're not seeing things like indemnities and
Of course not.
full discussions, baskets and caps.
Absolutely not.
I guess it'd be interesting for you to share with the group, both of you guys, you had some interesting thoughts on sort of baskets and caps. Certainly, and I'm as guilty as probably any of the lawyers in the room, we spent a lot of time thinking about baskets and caps. We attend ABA sessions on baskets and caps. We hear what the investment bankers have to say about baskets and caps. What's the market? As buyers of companies, what's your sense of baskets and caps? Are we spending way too much time in that area?
For me, let's say we're paying $20 million to pick a number for a company. If the seller doesn't want to have any exposure in the deal, once they're $20 million and they want to disappear, that bothers me a lot.
Sure.
Right? So, the best case is we get to go after them for $20 million if something's wrong. So you cover that with fraud. So that would be probably the biggest thing that would be the problem. But below that, you can measure, from my point of view, where your risk is, whether it's in the receivables, the inventory, or the customers. And if you get full disclosure with them, then you can negotiate a cap or a level of comfort for the seller. Most sellers don't know about basket and caps. If it's a privately owned company, they don't even know what it is until they're educated by their lawyer.
Sure.
Right? So, from my point of view, I've never done a deal that blew up because of a negotiated basket or cap. The issue always is, if they want them to be de minimis, then I'm very concerned about what I'm buying.
Joe, we've done a number of deals together, and I'm sure we've had conversations where we've gone out with a 24-month survival period, and the seller wants to negotiate it, and inevitably you're getting a call from someone in my office. What's your feeling having those conversations?
Well, the basket and caps and remedies are part of the purchase agreement. I understand that. However, the emphasis in whether this company is a good company or a bad company is, does it have brand equity? What's its position with its customers? Does it have leading technology? What's its ability to invent and innovate new products? What's its ability to gain market share? Those are the things that, in my mind, indemnify you from a bad deal. So if a company doesn't have the right position with its customers, doesn't have the right technology, the right team to develop new products, baskets and caps aren't going to make that deal any better.
So, Joe, you've hit upon some of the key things you look for in a deal. Don, are there other sort of key factors that you look for in your targets?
Well, I want to know, these are kind of trade terms that you hear all the time. When I started doing this, you can do the arithmetic if you want. 33 years ago, the term unfunded sponsor wasn't invented. The term private equity wasn't invented. I was just a guy who did deals, and there were a lot of them who did deals and figured out how to do them. So you hear things like defendable market niches, those kinds of things. I think it really gets into, from my point of view, it's the size, the market risk the company's in, what the competition is. And my history has been that I buy branded product companies, a lot of them in the food industry, a lot of them in the clothing industry, because a brand to me is always worth more money, or distribution companies. And the reason I buy distribution companies is you've got another defendable market niche. Typically, you've got a geography where they're limited as far as sales, or they've got a product that's unique that they get to sell.
Any absolute deal breakers that show up in due diligence that it's an absolute walk? Customer concentration issues,
Yeah,
things?
it's hard to do deals when somebody, we looked hard at a company that did 60% of their business with one guy. And I almost got talked into doing the deal. And shortly before we did the deal, the 60% guy changed the terms of his deal. And of course, the seller knew that, and he was trying to get me to close the deal in February, but he knew the change was going to happen in March. So, integrity, you got to have integrity on the other side of the table.
Sure.
Because if they're going to take advantage of you, we don't have a chance. They know more about it than we do. So when you meet the guy or person, woman, and they've got integrity, and you feel comfortable with them, that's a very different thing than they're trying to put something over on you.
Sure.
And we're going to learn from our due diligence.
Sure. We've got a lot of advisors in the room, and let's talk about sort of assembling a deal team. Don, are you working with an internal deal team? Are you hiring outside advisors? How is your deal team comprised?
Well, we're in the middle of buying a company right now, so let's talk about that deal. That company is about a $100 million business. We're adding it to a $100 million business we've got. The people involved in it are my lawyer, an outside accounting firm. We have a fairness or a quality of earnings report being done. By the way, there wasn't a term quality of earnings report 33 years ago. We've got a inventory guy going in to look at the inventory as an outside resource. And we internally have a couple of people that work for us that are big number crunchers.
Sure.
So all of those people are involved. And the advantage we have in the due diligence in this deal, like I'm guessing Joe always has in his deals, is we've got people that are already in the industry that can help us in that due diligence.
Sure.
And by the way, we signed the LOI December 1st. We'll close the deal at the end of February. So that's 90 days.
Joe, I know you've certainly worked with my firm in the past and some other outside advisors. What are, I've identified on the slides, but what are some of the key factors that you look for when you're engaging an outside advisor?
Steve, I did use your firm for every deal I did with the Varon Group. And the reason is I found you guys are not deal breakers or deal makers. And I've worked with so many attorneys representing the seller who were more interested in trying to break the deal or so bulletproof the seller or bulletproof themselves, the deal didn't get done. So the number one thing for me is to team up with an attorney that is, my attitude, you asked the question earlier, are there deal breakers? Well, I'll know a deal breaker if I see it, but my attitude is always to try and work around everything. And your firm did that with me very well. That was my number one reason why I never challenged your invoices, which were ghastly high, by the way.
So you had an advertisement and you just took it away.
Thanks, Joe. Let's talk about rates a little bit, because when we spoke a few weeks ago, what was interesting was my sense from talking to both of you was that hourly rates are important to a certain extent, but at the end of the day, they're not a driving factor, absolutely, if you feel like you're getting value from your attorneys. I'm not sure I'm pleased to hear that answer, but it was an interesting one, and I thought it'd be worth sharing with some of the advisors in the room. One of the things that's coming up a lot now is dead deal costs, which are killers to law firms, certainly middle market and small law firms. Dead deal costs are very hard to manage. How important is the law firm's willingness to deal with dead deal costs? Don, I guess I'll put this to you. How important are dead deal costs to you when looking at a deal?
We always pay the lawyers. We may pay them a little less if the deal doesn't happen. We may pay them a little more if the deal does happen. But if you've got a working relationship, the guy that works with me, he's been my attorney for 25 years. He understands the business. He's made a lot of money with me, and I've made a lot of money with him. So we're going to pay the legal fees. And I don't really care if he's charging me $600 an hour or $150 an hour. The facts are, if I'm paying somebody $150 an hour, it's probably costing me more than $600 an hour because they just don't have any idea. But if I've got a guy who really knows what he's doing, he cuts to the issues, we get the issues resolved, and we go on.
Just out of curiosity for the lawyers in the room, who's sort of negotiating dead deal costs? How big of an issue has that become in the last year or two? Okay, one, surprising. Joe, I know you've got, at Varen, you had an internal deal team. Were you incentivizing the internal deal team beyond straight comp? Was there anything you did in terms of, again, incentivizing these guys to get deals done? Or was that not an issue at Varen?
The Varen deal team was me.
Warren?
I was very incentivized to get my deals
There was
done.
others, I mean, there's other guys that worked on deals.
Actually, the only people other than me that did it was your firm, and then for part of the financial due diligence, I would use McGladrey. I always had a third-party market researcher who I hired to talk to the target's customers. Ostensibly, he was just doing market research or benchmark researching for the target, but that would give me a good idea of the target's position within his market base. But Steve, basically the people at Varen doing the deal was me. And from time to time, Warren would help me, but basically I was the deal team.
Don, in your organization, is there an internal deal team that you're working with, and are you incentivizing those guys based on deals that they're closing?
I have a very flat staff. It's really me and a couple of other
Okay.
people. And then we downstream it to companies we own. So we outsource both outside, and then we do things with the companies we own. But, it's hard to teach somebody how to do a deal. And frankly, I don't want to educate my competition on how to do deals. But when we're in a room, we can figure out pretty quickly whether we can do a deal or not, because we've been doing it a long time.
Sure. Let's talk about some of the characteristics. I think I've got to switch slides. Characteristics of a successful buyer of business, of a business. We've certainly identified a few up on the board. Joe, what are some of the key things that you think made Varen successful? Is a real player in the lighting industry?
I think the top three qualities of a deal maker are persistence, persistence, and persistence.
Okay. Don?
Well, I think those are great qualities. But you have to have, in addition to persistence, which I agree, and everybody in the room knows that you're going to get knocked down a lot, you got to get back up a lot. I mean, nobody in here is a kid. But I think that also the fact that Joe and I have done deals, and especially when you're dealing with a family-owned business, he can make a couple calls, learn about me very quickly, and he'll have confidence that we close the deal. And he knows that if I shake his hand, I'm going to deliver that deal if, in fact, what he's telling me is the truth. If we do our due diligence and it doesn't pan out, that's different. All bets are off. But I deliver whatever we agree to. And they can learn it very quickly. So if you show me a deal and it makes sense, you'll get a fee 90 days later, between 90 and 120 days. I don't have a committee. I just write the check, call a couple banks, and we're done. Pretty easy.
Are you both typically hiring the management team when you buy a company? I think, Joe, in your sense, if you ever...
Well, I typically acquired a management team that
Okay.
was in place. I mean, one of my criteria was the company had to have a strong management team in place. And even Hubble, who I'm still doing deals for Hubble, $3 billion corporation, one of their requirements is that they have a strong management team in place with the acquired company.
I'm not a manager, so I want to have good management in place. We've changed management, it's always heck. I mean, it's never easy. So we'd prefer to have a strong team in place.
Joe, as a guy doing fold-in acquisitions, how many deals are you typically looking at one time?
Well, when I was independent, before I sold to Hubble, and my primary focus was on acquiring, I looked at 20 to 30 deals a year to do one.
20 to 30 do one. So of the 20 to 30, how many are you really, do you sort of get past that first cut with, how many do you bring to the dance? At
Probably 3 or 4.
Okay. Don, how many deals are you looking at?
Oh, we look at a lot of deals, 50 to 100 companies a year. But that's just a cursory look. There are a lot of quick no's. But if we get into the letter of intent stage, we close the deal. I mean, we've already done our due diligence to figure it out. Unless they're, as I said before, not telling me the truth. And that happens. It happens to you guys too. They overstate their inventory or some other nonsense like this company that I said before, where they couldn't tell me they wanted to close in February because they knew in March that the biggest customer was 60% of the business was changing the deal. Obviously, I'm not going to go back and try to do that deal. Integrity is important.
Don, there's a lot of sell-side advisors in the room, and you've done a number of deals where there's been a sell-side advisor. What are some of the things that you've seen from sell-side advisors? How can a sell-side advisor make a deal? What can a sell-side advisor do better to get a deal done?
Get a retainer. I'm not kidding. If the guy won't give you a retainer, he's not serious. So you got to manage him just like you try to manage the process. Understand that you've got to understand the market, you have to understand what's realistic in the market. And I tell people, I'll ask them right away, if they're showing me a deal, I'll say, do you have a signed agreement with them and do you have a retainer? If they don't have a retainer, I don't want to look at the deal because the guy's not serious.
Anything
So
else?
get a retainer.
Anything
I
else?
mean,
that
you
think-
shouldn't work for free, right?
Absolutely. What
I
else?
mean,
from
you
s-
wouldn't.
Definitely not.
Okay.
I could vouch for that, but
What else from sell-side advisors? Again, there's a bunch in the room, and what can we?
I think they've got, for me, I've got to see financial statements, understand the business, understand the organization of the business, and they need to be realistic with the seller in what the market will bear. We all want to make $100 million, right? Nobody's against that. But if the guy's doing $10 million in sales and makes $1 million a year, first of all, that wouldn't be my deal. But if he is, the company's not worth $50 million because the market's going to grow. So you just have to be realistic in the approach, or you're going to be wasting your time.
I'd like to add a little to that.
Please.
Even though I was finding my own targets, when I got past the LOI stage and started to get into due diligence and the purchase agreement, I always wanted to have my seller find an advisor. And the reason is that my seller is not shopping his deal, and he always had a opinion of valuation that was nowhere near market or what I wanted to pay. So having, and this was always the case,
Absolutely.
so having a professional advisor who was more aware of the market and market values was always a big benefit to me. So I think that you sell-side advisors provide a real service. And to Don's comment about get a fee, I had a couple friends in the past 12 months who asked me to help them sell their small businesses. In both cases, because they were friends, I did not ask for a retainer, and I worked on a success fee, and in both cases, they both got seller's remorse. I put a lot of time in for nothing, so get a fee, get a retainer.
When do you guys judge the outcome of a deal, whether a deal is ultimately good or bad? When do you finally make that decision? When do you come to that conclusion?
I get asked that a lot. It's kind of like life. You really don't put a line underneath and add and subtract till you're dead, then it's too late. So the deal business is a little bit like that. When you sell it, you've made a good deal. because things can change. But that, for me, primarily, I'll know whether it's a good deal or bad deal pretty soon, but I'll really know whether it's a great deal when we sell it or get some kind of opportunity financially from it.
Joe?
For the most part, I agree with what Don said, even though I was building a platform that I ultimately would sell, because I brought investors in when I started both companies, and the way they got out was we had an exit plan to sell within 8 to 10 years. So the ultimate success was that it sold, but between that and the time it sold, operating profit and cash flow were, for me, very good metrics that I had made a good deal.
That's fair. But when you're looking at a deal that's being sold by an advisor, especially a bigger investment bank, and they send you a document that says you've got document number 44GAC, and they've shown it to 500 people or whatever, and you won the deal, when the deal closes, you wonder what you won. Because 499 other guys went, wait a minute, this isn't a deal I can do that way. So you never know.
Let's talk a little bit about integration issues. Joe, when you start, you're in a LOI stage, or you maybe think you're going to end up with this company. When do you start planning for the post-closing integration?
In my case, before I sold to Hubble, we began that process as soon as we had the LOI and we knew we were going to do the deal. And like Don, if I got to LOI, 95% of them got closed. So from that point, from the point of the LOI, we began our integration planning. And are there any Star Trek fans in the room here? Anybody know the board?
Anyone want to admit to it?
Anybody want to admit to it? Well, I was on the other end of integration. After selling to Hubble, they assimilated me, and it was painful. They didn't do a very good job of planning it, so.
How important is it in terms of integration to have a designated integration team leader? Is that an important thing, or is that not a real significant factor in having a successful transaction?
Addressing that question to me, Steve?
Sure.
Yeah, it was very important on my end when I was building Varen, and it's a Hubble's practice, and it's very important to have a champion of the integration.
Don, you agree?
Yeah, not only a champion of the integration, but, the key to doing a deal is the due diligence you do in front. And then you need to, if you're putting a business together, not to speak for Joe, but when I've done it, when it's been very successful, you have a plan in place that makes that due diligence in front come into play. The minute you don't do that, you're digging a hole each time, and you're wasting money the longer it takes to integrate them. So what we'll do is we'll have weekly meetings every week with the team about what they're supposed to do before we buy it and what's going to happen, where we think the opportunities are, in a weekly meeting after we buy it to know what's going on. It may not be, it may be a long meeting, it may be a short meeting, but we want to know what's going on every week and set goals and objectives in order to make sure the company's integrated.
Joe, were you meeting weekly or more frequently in the integration stage?
We were reporting, after the Hubble acquisition, I reported monthly, and when we were independent, my program was to meet semi-monthly.
Okay.
So frequently, yes.
What are some of the other, I know we've posted, but what are some of the other sort of key takeaways from integration, some mistakes that people should be avoiding? Because obviously integration is a huge part of any successful deal. Any other advice for the group?
Identification of the key players at the target company or the acquired company, and a plan to keep them in the game somehow. I think Don said earlier, the last thing he wants is to have a key guy not stay with the company. And when I would buy, I made sure all the key people were identified. I made sure they all had employment contracts, at least for a 2-year period, and I made sure that they had some ongoing incentive, either a share appreciation program or some other deferred comp program to keep them in the game for a while. So keeping the key people at the acquired company, for me, was a key issue on integration.
Don, do you want your management team to have skin in the game, some sort of equity, phantom equity? Is that significant these days?
I don't like partners, so I think about it differently than other people do. I find that if he's my partner, then he's my partner on the good part, but he doesn't want to be my partner on the bad part. So I want to incent them, but I don't really want them to put up a lot of capital to be in the deal. It's just, life experiences.
Joe, as the world has changed since late 2008, do you see equity is less important these days, or do you see any change in sort of the value of equity to a management team?
I think it depends on the whole compensation package. It's the all-in package that matters, and I believe that some kind of equity is important. Yes. The guys that I bought, the deals that we did at Varen, every entrepreneur held some equity, and they made a lot more money because of it when we ultimately sold to Hubble.
So that's different than what I was talking about. If you're addressing someone who's never had an equity interest in a company, that's very different than an entrepreneur, right?
Yes.
Because he understands the skin of the game part. But I find that normally if you buy, because I bought a lot of divisions of companies, public companies, as opposed to family businesses, I find that if you create some great big equity opportunity for a guy who has traditionally been a divisional manager of a business, he looks at it the same way he looks at the benefits of his other insurance plans or how many hours, days of vacation a week he gets. He just isn't thinking about it the same way as an entrepreneur would think about it.
I think that's fair. I see it with the Hubble staff. I see everybody there has a stock, either a restricted stock or stock options, and they're clearly not incentivized by that.
Let's talk about sort of 2012. I know we're going to have a panel later, but I'd like to get your guys' perspective on sort of the market today. What do you think is, what do you think are the key drivers of M&A in 2012? Don, you're probably a little bit more actively in the game. Is 2012 going to be a good year for you?
Yeah, I think it's going to be a great year. I think it should be a great year for you guys. Because whether it's real estate or buying a company, in the deal business, it's really how much money you can borrow and at what rate. Just had the Fed say yesterday or 2 days ago, they're going to keep rates very low for the next 2 years. That's a big deal. Look what happened in the market the minute they made that announcement. So the availability of funding is there, and banks want to do deals. They were on the sidelines 2 years ago. You couldn't get a deal done with a bank if you begged. And I've got a lot of long-term bank relationships. What was interesting is you take the best banker 2 years ago, or 2.5 years ago, they take the best deal guy and they put him in workout. So all the guys who were doing deals were now trying to fix the bank's problems. Today, you see those guys who were in workout, now they're bank doing deals. So banks want to do deals. The private equity guy, I think there was one private equity person in the room, right? You? And private equity has more funds than they've ever had to put out deals. They got to put the money out. If they don't put the money out, they don't get the next deal. By the way, private equity is the bane of my existence. No offense.
Let's explore that. Why?
Well, I bought Danskin for $200,000 and bought a $40 million business that did paid $40 million for a business, and I owned 80% of the equity by doing it, right? That was 20 years ago. Today, everybody wants me to put in lots and lots of money because I need skin in the game. But I care about the cash flow, and I'm always competing with some private equity guy. No offense, it's a great world, you've got a great gig. But the facts are, it's not their money, it's my money. And they're raising money from widows and orphans in order to get it done, the pension funds and firemen and all this other stuff. So, and I have this great discussion with a couple of my buddies who are been in the business for a long time, and they're always teasing me because I never raised a fund. But it's a different thought process than what I do. What I do is I invest my own money, and I want to make the deal really work, and I'm committed to it. And I'm not thinking about raising the next fund. I'm thinking about what other companies I can do with it. So I think this year will be a good year. I think next year will be a good year. I'm not too worried about the election because we've all been dealing with political guys forever. I don't think it'll make too much difference whether Obama's elected or whether whoever in the group of characters on the Republican sides are elected. I do think, though, just a political aside, maybe there's Gingrich fans in here, but if you want Obama elected, get Gingrich to get the nomination. Just my viewpoint.
Don, are you looking at any cross-border, it's tough to segue off of that. Are you looking at
It's just a comment.
any cross-border deals? Is that on your radar?
Not really. If it's in Canada, we'll look at it. We can't do anything in Mexico. And we owned a company called Repetto in France when we put the Danskin deal together, and that was a nice deal for us. But it's just, I don't care about it. I've got plenty to do in the United States.
Are others in the room looking at cross-border deals? Linda, how are we doing on time?
2 minutes.
Okay. I guess I think we're at a good spot. I guess we'll open it up to questions.
I built, in the first case, it took about 10 years to put the platform together and sold it to a company that ended up selling it to Philips. In the second case, with the Veron Group, started it in 2000, and we sold it in 2008. And it just, for me, it was a matter of when was the market right to start shopping the deal. So in one case, 10 years, second case, it was 8 years.
The shortest time I've owned a company is 18 months. Longest time I've owned a company is 15 years, 20 years. So it really doesn't matter. The reason I owned the company 18 months was because somebody really wanted it, and I was willing to sell it to them. So it just depends. I don't have a time frame.
Please. Okay. Please.
Your principles of price negotiation, once you get the initial, is it pretty much here it is, or are you willing to flex to your own 5 or 10%, or what are your personal rate wants?
I have to have a deal that works. I can't pay a price where the deal doesn't work, and that can be defined a myriad of ways. But it's got to be a realistic deal so that the seller makes money and we make money. And, you know, it's pretty easy to do the financial equation to figure that out. And there isn't, you know, I find it interesting today, everybody talks about EBITDA. 20 years ago, I bought a company and we were able to write up assets, and I sat down with my banker and we'd written up assets, so we increased the depreciation on the deal from $500,000 a year to $1 million a year. So I sat down with the banker and he and I were chatting, and he wasn't really the brightest guy in the room. And he said to me, you know, Don, you're behind, your business is behind last year. I said, why is it behind last year? I said, the sales are up. I said, the cash flow's up. He said, what do you mean the cash flow's up? You're making less money than you made last year. I said, that's not true. We're making more money than we made last year because our depreciation is higher, so we're sheltering our income in that deal because we wrote up the assets. And the banker was sitting there, and he had glasses on, and he was kind of sitting back listening to me with disdain, and he goes like this: don't confuse depreciation with profits. So today, every deal you look at, it's got EBITDA. So I think the one comment about valuations is if it's a capital-intensive business, you've got to look at the depreciation. And people many times will tell you, oh, well, when you buy, they've spent a lot of money on capital goods in the last few years and made a big investment, so you're not going to have to spend anything on it. All that depreciation will come to you. That's never the case. You almost always have to look at the depreciation and offset it against what CapEx you're going to have to do, almost dollar for dollar in a CapEx business.
I'd like to add to Don's answer as well, and that is separation between the enterprise value or the valuation and the structure of the deal. So price is really a function of structure, I think. So there's always a way to bridge the gap between what the seller thinks it's worth and what you think it's worth, and whether you do that in having the seller hold some kind of stock or equity or an earnout or other elements of the structure, I think, address the valuation.
Yeah, there was a guy that passed away a few years ago named Jerry Wexler. I don't know if any of you guys remember that name, but he was, long before the term private equity was around, when Jerry died, he had $3 billion in assets. He was a huge deal guy, both in the real estate business and in the operating company business. And he had two things in mind about deals. One is, he wanted to return every call he got the same day he got it. Now, when you control $3 billion in assets and you're a well-known guy in Chicago, you get a lot of phone calls with a lot of ideas. So he didn't care where the next deal was coming from, didn't know where the next deal was coming from. His goal was to return everybody's phone call. And I kind of have that mindset. Unfortunately, everybody emails me now, and the problem with that is that you don't interact. If I can talk to somebody, I get a better chance of turning it into a deal. And Wexler's other thing was, which I find kind of interesting, is I named the price, or you named the price, I named the terms. So he would pay a price, but he would negotiate the deal so it would work. And that's kind of the way it works for us, I think, right?
Yep. Thank you for having us.